but I think we can see out about 8 to 10 years, we're going to be in an inflationary environment. Ross laid out many of the reasons why. It's challenging for any central bank anywhere in the world to control the supply of money, and we're going to have expansionary fiat environment for a while, and credit is flowing freely. The interest rates are at an all-time low. There's no indication that interest rates are going up. So that creates an interesting dynamic. We have two interesting trends here. First of all, Bitcoin is digital gold. Second, Bitcoin is an emerging digital monetary network. Both of those are interesting and critical to corporate strategy. Let's talk about digital gold as harder money and market dynamics. Basic principle of market dynamics is capital is going to flow from weaker assets to stronger assets until every asset is equally attractive on a risk-adjusted basis. If I have one asset that's yielding 10% return and the other is yielding 5% return, and the risk premiums are exactly the same, then, and the risk is exactly the same, then people are going to sell the one asset to buy the other asset. And of course, the prices will adjust until the actual yields are the same. This works with any asset, although it's kind of hard to calculate the risks with equities and real estate and derivatives and bonds. On the other hand, currencies are a more pure asset. So generally, weak currencies are going to have capital flow out of them into stronger currencies. Truly weak currencies may just continue to see capital outflow until the currency itself collapses. That's a dynamic that's driving this market. And the appeal of Bitcoin as digital gold is as a strong asset, and capital will flow to it. The second dynamic here is that we need to take into account, it's a technology dynamic, which is, digital gold is smarter, faster, stronger money. It's not just harder money. It's smarter, faster, stronger. It's monetary electricity, and it's monetary electricity flowing on a network. And Ross made this point. So you can build a Bitcoin into any financial product, or you can build it into any technical product. And so that means that Bitcoin as digital gold is interesting as a hard money asset to any corporation handling money. But Bitcoin as a monetary network is interesting to any corporation that has financial products or technical products. And so I'll leave those as two high-level thoughts. Now moving on to corporate strategy. What's every CEO think? What is the elements of corporate strategy? Well, first point, I want to grow my revenues and I want to grow operating income derived from the generation of revenues minus cost, operating income. Every company knows they want to drive revenues north and drive operating income north. Second idea, I would like to grow my assets and I'd like to grow my investment income. If I have $1 billion and it's generating zero, I have no investment income, I have $1 billion in assets. If I can drive that to be $10 billion in assets with a 20% yield and have $2 billion a year of investment income, better. The same idea of revenue holds for assets. So growing revenues, growing assets, and growing operating income and growing investment income, these are all objectives of a corporate strategy. And if we put on our shareholder hat, I want to create shareholder value and I want to preserve shareholder value. And the creation and the preservation of shareholder value is somehow, in many ways, related to how I drive revenues assets and incomes after we take into account the leverage on the balance sheet. So the next thought that colors our considerations here is in a macroeconomic environment where the currency is weakening, the road to serfdom is working harder, ever harder, to earn a currency growing ever weaker, and then investing the proceeds of that work into assets that are growing ever riskier. Or even worse, to surrender your capital base completely. For example, you wouldn't really think twice about if you had savings in your family, you wouldn't give them all away before you had your first child. You would think, I need to have money so I can support my children. So family would want to accumulate assets, not give them away. On the other hand, we're in a macroeconomic environment where there's continual pressure on corporations to surrender their assets, to buy their stock back, which is a way of surrendering assets, or to issue dividends, which is another way of surrendering assets. So why do people buy their stock back, and why do they issue dividends? Well, the view is their cash and their treasury is not beating the cost of capital. So if the cost of capital is 5% and you're getting 0% yield on your cash, you're under pressure to surrender your treasury assets. And of course, that's good for the shareholders, but it's awful for the company because the company is decapitalized. It's the same as giving away all your family's assets. It's good for whoever got the assets. It's bad for your family. What's really dysfunctional? Well, the idea that you would issue debt to pay a dividend. What if I borrow $1 billion, dividend out to the shareholders? Now the company owes $1 billion. The shareholders have the billion, and my customers and my employees just owe $1 billion. So issuing debt to pay dividends isn't really good corporate strategy. In fact, you see the last 20 years is littered with bankrupt companies that actually did LBOs. They leveraged buyouts, they issued debt, they paid huge dividends to their shareholders, and then the company itself is rendered insolvent by misfortune or difficulty in business. Issuing debt to fund operating losses, not much better. If the company is losing 100 million a year after year, and it just borrows $1 billion and keeps losing money, that's also a road to serfdom. Funding consistent business failure with debt is just putting off the inevitable. Issuing debt to buy your stock back, not really much better. If you issue $1 billion of debt, buy $1 billion in stock back, well, the shareholders have take off with the cash. They look to invest it, but your company has $1 billion in a liability. You've created a little bit of leverage, but you burden yourself with liabilities. Now, why do companies do these things? Well, because debt is cheap and because they're under massive pressure from outside groups to generate a positive return on their capital. And as the cost of capital keeps going up, they can't, or at least you can't with traditional treasury strategies. If you're investing in government bonds or T-bills and the cost of capital is 7%, well, you're not beating it. When the cost of capital goes to 15%, and that's about where we are right now, probably 15% or more, there isn't any conventional treasury strategy that's going to yield more than 15% risk-free interest. What happens next is there's this massive pressure to give the capital back to the shareholders because they realize that shareholder value is not going to be preserved in cash. Now, that's a way of capital preservation. If I take tens of billions of dollars and I dividend it back to shareholders, the capital is preserved because they're going to presumably invest in something that will beat the cost of capital. But it's a method of corporate destruction. The companies, which create the jobs and they create the products and the services, they're being destroyed as the capital flees into some other place. So What causes this? It's macroeconomic pressure. If the environment was only growing the money supply at 2% a year or 1% a year, there wouldn't be so much pressure. When the macroeconomic wind is blowing at a 5% monetary expansion, which is what we've been like in for the past decade, there's a lot more pressure. When the cost of capital goes to 15%, becomes extreme pressure. And now every company has to make one or two choices. You either have to decapitalize, which is kind of like self-destruct. You're going to, capital is lifeblood, you're going to self-destruct, or you have to recapitalize with an asset which is going to appreciate faster than the rate of monetary supply expansion. This is where Bitcoin comes in. Now, I think there's a useful metaphor that you can use to try to figure out what's a good corporate strategy with regard to Bitcoin. And I'll call it the parable of the Argentine rancher. Let's say you have a ranch in Argentina, and it's a profitable ranch in Argentina. And this is sometime in the distant past, 10 years ago, 20 years ago. And what if I told you macroeconomically that you can expect the Argentine peso to weaken versus the US dollar by about 25% a year? This is not such a far-fetched idea, because the peso went from 1 peso to the dollar, to 2 to the dollar, to 4 to the dollar, to 8 to the dollar, to 10, to 20 to the dollar, to 40 to the dollar, to 60 to the dollar, to 80 to the dollar, to a black market rate in excess of 100 to the dollar. So the Argentine peso has collapsed against the US dollar in that range. So let's say you're a really intelligent business person and you run that Argentine ranch. If you knew this was going to happen, if you knew the Argentine peso was going to weaken in purchasing power against a benchmark, and the benchmark we'll say is the US dollar, what's a rational corporate strategy? Okay, by the way, this is not that hard. First, you're going to take 100% of your Argentine pesos in your treasury, and you're going to convert them to US dollars. Because if you have $100 million in pesos, when it's 100 million pesos, if you look out, eventually you're going to have 100 million pesos worth $1 million, and you're going to lose 99% of your wealth. Okay, so you convert your 100 million pesos into $100 million.